Well, Jack, thank you for coming on. I think where we're going in the economy, we're going to lean on your expertise. You've been through a downturn. What do we need to know before we start investing as we're going into a downturn?
No, I think you're right. I think a lot of I've learned from my own mistakes and mistakes of others over the years, and
Yeah,
I think a lot of times I would say, especially if you're in the real estate space, and
yeah,
kind of some of the first things that I always like to think about within that space are, why real estate, what do you need to know, and things along that line. A lot of times it's insufficient research or planning. Like, so a lot of
yeah,
things that, if you want to play, like now, if you want to think about real estate with rates going up the way they have, and start thinking about these things, and where your particular expertise, your comfort level is,
hmm,
because real estate is a liquid asset.
yeah,
Depending if you're going to do it you're going to buy it outright, you're going to
yeah,
buy securities, whatever it might be. So I think it's really kind of understanding, kind of where your comfort level, it really starts there, where
hmm,
your comfort level is, and
yeah.
we can kind of walk through the process of how to establish that comfort level if you like.
Yeah, I put a poll out on YouTube last night, and I thought going into 2023, which asset class would you be most likely to invest in? And I put obviously multifamily, industrial, office, retail, and I put parking lots just kind of as a throwaway comment. You can't believe how many people are interested in investing in parking lots. So I guess, what, as many years as we're in the business, you never really know. And, some people made some comments and said, yeah, I'd love to own parking lots and in the right areas. And so that was shocking to me. But, I guess let's start there. If you could, Jack, in 2023, you're starting over, you're getting your career investing starting, where would you go? How
I
would
think
you get
it's
started?
yeah, no, I think it's first of all, I think the one thing I would think about is depending upon my time horizon. I think a little
Yeah.
bit about my time horizon on the money front, in terms of how long can I be invested? Is this discretionary money to where if I make a mistake, I lose it, I'm okay, or I can kind of sleep at night, if you will.
Mhm.
But I would say fundamentally, I like the multifamily sector. I think
Yeah.
housing and what the way I like to think about things, I start from kind of a macro standpoint, and kind of look at demographics, population growth, things along that line. And for me, I like the southeast, southwest, in terms of where to be. I like the multifamily sector. I still believe in housing. I think housing's, people need housing. The one thing you got to be careful about, though, I would say specifically in that arena, is there's been a lot of development specifically in
Mm.
the housing sector, but a lot
Yeah.
of it, a lot of it's been, class A plus, if you will, at a certain price point above $2 per square foot type number, and it gets a little pricey. And I'm always a firm believer and thoughtful about, depending upon the percentage of your income that you're spending on housing, if it's over 50% or whatever, you're not necessarily going to care if you have a granite countertop
Yeah.
or a nice slick stainless steel appliance. So that's the reason why we're super careful and thought. I like the multifamily space. We like the southeast. We got to be careful at the price point. A lot of the stuff we're looking at, we actually ended up buying something out in St. Louis.
Okay.
It's a value add play. We're spending a bunch of money to fix it up, like the basis we're in. But I think one thing we're super mindful of is, what's the incremental improvement that we can make to the property, that supports kind of the tenants that are there, allow us to grow the rent a little bit, and things along that line.
Yeah. Are you finding that the multifamily deals we're seeing across the West Coast, is our sellers are still here, our buyers are here, and this void it's very tough to get that together right now. Are you seeing that across the country as well?
I'll tell you, Joe, 200%. When I first
Yeah.
started Summer Street after coming out of GE Capital back in 2009,
Yeah.
we had the gap, right? And
Yeah.
here we are again.
Yeah.
Sellers always, looking back 6 months saying, "Hey, I could have gotten 100, now it's 80." We'll see a
Yeah.
bunch of that, and I think there is a natural reset. And the other thing you got to think about too is the cost of debt. You look at the 10-year. Back in March, it was 170 over. Now it's what, 350. So the cost of debt's gone up. So typically what's happened there is just there needs to be a reset. And what happens generally during these periods is you go through that period
Yeah.
where there is a reset period between the buyers and the sellers. There's going to be opportunities. There's going to be opportunities based upon that reset over the next year or two.
Yeah, we're really starting to see it. We had two clients yesterday, two different agents, and they've been advising their clients, right, listen, you need to reduce, we were at market. They actually had deals on both of them that they should have taken. The agents were saying, you need to take this, interest rates are going to go up. Cut 2-3 months later, both of them walked in yesterday, go, listen, these guys are, I don't know what to do. They won't reduce, but they are screaming at me to get it sold. And then of course there's the other commercial agents are saying, hey, give me the listing, I'll get it sold for you, and instead of just bringing the buyer, right? So it's a battle.
But I would say, Joe, right now, honestly, one of the mistakes that I see people make right now is not akin to what you're talking about. Really define what you're interested in, understand it. But I also think the other part, and let me understand it in terms of property management, if you're going to do it directly by yourself or go through a sponsor, whoever it might be, to really understand them and understand the track record. The other thing I'd say specifically too is in the finance side. Yeah. How are you going to finance it, and who's available? Because the groups that were available 6 months ago, a year ago, are out of the market. Last year we underwrote $10 billion in transactions for a bunch of banks and debt funds and hedge funds, and a lot of those groups, probably about 75% of them, are out of the market right now. So I think right now, especially as you're looking at things as a buyer, to make sure that you have a good relationship with a finance source, be it a private lender or a bank or wherever it may be, and understand kind of the nuances of that. They may give you some money right up front, but what happened, honestly, we had two groups. One bought outside Nashville. They bought a multifamily project, bought it right, and they had a cap. They bought another property in Orlando without a cap. The lender required it. The economics on the deal on the first one are doing great, but with the movement in rates, the second deal is not doing so well. So I mean, my point around that is in terms of know your financing source, in terms of the rate piece of it. But the other part of it, I would say to know is to really give yourself enough flexibility and optionality to really understand, if you're going to do a refinance or not, it's going to do a rehab, it's going to take a year or two. You might not want to get a note or a mortgage or a transitional loan for 2 years. You may want to get something that has some optionality for you. Yeah. Just because you find that, especially with COVID, supply chain, and all the other crazy stuff we've had over the last couple of years, a lot of things have taken a lot longer than. So just when I tell investors or first-time buyers, think about those types of things.
Yeah. Now, as a lender, I mean, it's sounding like rents are going to be going down, right? Driving some prices down. How do you look at that from a lending standpoint? Is there percentages that you're looking at? I think it's going to go down this much.
No, what we do, and again, for Summer Street, we manage the appraisal review process for a bunch of banks. Okay. A ton of banks, and groups. And so we're very much about valuation and thinking about this. Over the last year or two, you've seen, I'm sure, year-over-year rent increase. You look at the CoStar data, 12% nationally. That's not sustainable. If you look at the REIS of the CoStar data, generally in most markets, it's 2 to 4% a year. So what we anticipate, and that's what we do. We will when we look at something, we will do a full-blown analysis. We'll take if you're the buyer, we'll take a look at your projections in terms of what you anticipate, what you can do with rent, what you can do with your expenses, and thinking about those things. But we also specifically take a look at what we think is realistic. And I think especially in this current environment, I think with more moderate growth going forward, you got to be thoughtful about that. Yeah. And that's kind of, but that's the reason why we take the third party sources. But then honestly, like what you do, and I know what you do with your firm, we get with the local market. We would, if we're working in Los Angeles area, we'd call you up and say, you guys are the smart on the ground folks. What's going on at that, looking at that walk the market, understand the market, understand, shop the comps, understand really what's happening. So that's a lot of, kind of doing a lot of that stuff. So that comes back to really becoming an educated investor or an educated buyer.
Yeah. It's, I always say, treat it like a business, right? You've got to do all your due diligence, and not to get off onto crypto, but I'm still in shock that all these big major VCs that invested in FTX and they were running the whole thing on QuickBooks. you,
Joe,
you want to do better. You want to be
yeah,
a
but
little
Joe,
bit smarter.
but Joe, I'll tell you this, honestly, and I've kind of we've done it all.
Yeah.
We've gone to, I've been down in Puerto Rico, worked for Doral Bank,
Right.
looking at 3,000 plus loans and valuing or going, figuring things out. And this most recent fiasco it's not surprising. It's just, you remember back in 2000, the new math,
Yeah.
when we got all these emerging businesses, what was the little dog or the little sock puppet, whatever it was. And I'm like, when is this thing ever going to get net income, positive net income, right? And they're like, oh, we got to use a new math and things like that. So the reason why I'm super careful about real estate as well and thinking about the fundamentals. For me, it's so careful, as tell me about your sponsor, tell me about the sponsor, tell me about your track record, tell me about that unique opportunity. I'll tell you the other thing that we always tell people too, when you get the finances, if they, in terms of, I always believe, I want to see the rent roll. I want to make sure the cash is in the bank. I want to see the contracts, because the reality is people will, when I guess novel concept, what we do when we bought the St. Louis property, I had my team here from Connecticut. We flew out and we were there. We walked every unit.
Yeah.
And we made sure they're occupied, noting deferred maintenance, all of that stuff. So it kind of honestly, Joe, well, we're kind of in an environment where blockchain and technology and all the new stuff on the block are great. And I believe in it, but I also believe in some old school, it's almost like it's almost like the baseball stuff, with using the analytics and kind of using the gut. So we try to when we do our work, that's what we try to do. We use all the analytics, but we also try to marry that with logic. And how can, like I said, when we look at an opportunity, how can I get hurt?
Yeah. Yeah. It's, it's the opportunities there. You just got to know what to look for. Now, if you're getting ready to, I'm thinking about doing a syndication. What are the steps I should be taking a look at right now? Because I get people that want to invest in a syndication, and I get a lot of people that want to do a syndication. And I know you're always looking at those. What are the hot spots those investors are looking at?
Yeah, when you're looking at specifically when you're talking about syndication, are we talking about equity syndication? Yes, or debt? Yeah, and I think because obviously because you can a bank can syndicate, they make an investment and they syndicate the debt. The biggest thing I'm always careful about that is it's almost like the thing that concerns me about that that type of structure is it reminds you of the ticks a little bit, right? Meaning it's typically it's LP money. What LP money is it's a class of stock that has usually within the syndicate has very little control. And they basically, you look at the slick brochure, it looks great, and the like. But the problem I find sometimes is things happen. I just know that there may be a capital call, or there may be some additional things to as they would, especially with all especially with what's gone on with inflation and things costing more than we anticipate. How many projects that I'm involved in where we initially thought the budget was X and now it's X plus 2 or whatever it may be, whatever it may be. So one of the things I like the idea with the syndicated capital. I'm also super careful. For me, it all comes back to tell me about the sponsorship, right? Tell me who the group is that's sponsoring it. I want to know specifically about the opportunity, and I want to know what rights do I have and what's my exit? When am I out? Yeah. Those are the things because because everyone will promise you, I'll give you a 15 IRR on a 3-year hold, right? That type of thing. But I always like to think, I said before, I always like to think about, and they'll give you a nice current return and this and that and all these things. But for me, it comes back to really those types of things. And if I'm looking at a syndicated credit or syndicated equity, or if I'm looking at, if I'm looking at a huge private equity group that's got, whatever, 700 million and they got 40 investments, or we're looking to buy them or someone's buying them or whatever, it's the same type of thing.
Yeah. All right. All right. So multifamily is your favorite right now. What's your number 2 favorite asset class going into 2023?
Yeah, let's see. It's a great question, and let me think about that a little bit. What's my, it's what, everybody likes industrial, but I'm kind of a little leery. I'm a little leery of industrial.
Overbuilt, you think, or going to be overbuilt?
I think a little bit. I'll tell you, I'm going to take a flyer a little bit with you.
Okay.
I think you can do with appropriately thought of. I'm going to say retail. because
Yeah.
the reason why I say retail, you know, thought of appropriately, meaning you got a grocery anchored center.
Yeah.
There's a reason to be there,
Yeah.
and you got a strong sponsor. They've been doing it, and I get paid for the risk.
Yeah.
Because right now, a lot of you look at a lot of right now, and even the multifamily stuff where we've been cap rate, and you look at the returns there, they've been low.
Yeah.
But I think that, you know, like I said, I think retail is, excuse me, I think office is the new kryptonite, if you will, right? Whatever. Whereas I think now, I think the retail is I think it's gone through enough of a transition. I think
Yeah.
a lot of the more marginal retailers like Payless Shoes or Radio Shack have all been marginalized.
Yeah.
I think there's a lot of I think there's some opportunities there.
Yeah. Yeah.
How about yourself, Joe? What do you think? I'm
I
curious
think,
what you think.
it's funny with retail, but that's what a lot of our agents are getting calls on, is a lot of retail.
Yeah.
Multifamily's tough. Finding it is tough, because we got hit with in LA, this new sales tax on real estate. So that's got some people like, holy, first of all, I can't believe how many people didn't know about it, but it's going to add hundreds of thousands of dollars to their sales. So they're really deciding what to do, but that's going to go in place, I think, March 1st or April 1st. So they're going to have to make their decision soon. So that could loosen up some multifamily, but retail is the phones have been ringing. Office is very tough. I don't know, downtown LA especially.
It comes back. I'll tell you, we actually, I was talking to a Korean bank
Yeah.
last week, and they did a deal up your way,
Okay.
up in Seattle, and
Okay.
it was what you came back to there was the tenancy. You had Facebook or Meta
Yeah.
along with the Navy. So it comes back to credit. But I'll tell you, Joe, my perspective on it right now, this is why I know what you're doing with your agents, is getting them smart.
Yeah.
In terms of, it not, I think sometimes where things get, you kind of get everything grouped, like everything now, offices, no one wants to be in office, what's the transition, et cetera, all these other things. But I think there's also opportunities where there you can find nuggets. And I'll tell you, one of the things we're doing right now is we're rolling out a program. We're going to do office or hotel to multi-conversion.
Okay.
So we're using, so doing that type of stuff because I think you get them at the right basis, which I think basis is very important, as you know, for investing or buying real estate. Gives you a lot of I always look at it, gives you a lot of latitude to make mistakes.
Oh yeah. Yeah. I can afford it.
That's right. So we're doing some of that stuff as well.
Now, do you think that cities are going to come in and start offering value for people that are going to be converting office into multi-tenant?
Yeah, no, 100%.
Yeah.
You look at Hartford. Yeah, I'll give you a perfect example.
Okay.
And it's interesting. I'm part of another group, and one of the gentlemen that is active in that group did two or three office, Class C office buildings in Hartford, Connecticut, converted into multifamily. There was some type of municipal support,
Yeah.
but I think honestly, Joe, I think there will be. I think there'll be some there are creative programs, where you can using tax credits and different types of structures that again, having those vacant buildings occupied it helps everybody.
Yeah. I think, and I know we've been through a few downturns, both of us, but I think this is my third one actually, but you'll be amazed at creativity that people start having. People all of a sudden, you're like, damn, I wish I would have thought of that. It's just, there's going to be a lot of great entrepreneurs that come up with these ideas that work, and you're going to see that going forward. So anybody watching this, you just got to get creative.
Yeah, but Joe, that's the reason why I would think if you were looking at something near you, and you look at that building, and the way I always look at that stuff is hey, we were to buy that building at the right basis, who knows, it's $30 a square foot, whatever. And what's the cost? And this is the kind of the way you go through it. What's the cost to convert it? And what are the market rents that we could achieve, right? Doing this, and then you look at it, you take maybe 3 years to stabilize it, a year to do the build out, another year or so to kind of start filling up and whatever, and then I hold it for another year on a 3-year hold. What's my IRR? And then you present that story to a potential investor, or either through a kind of like the syndication we talked about, or through a whatever. But that's the process to think about it. See if the deal pencils out or makes sense.
Yeah. Yeah, it's just, I think there's a lot of people, and I'm seeing it, a lot of people have got cash sitting on the sidelines right now. And I'm sure you're seeing it as well, but they're waiting to really come up with, create some opportunities for themselves. And I'm looking forward to it. I really think that there needed to be an adjustment, right? We couldn't keep going like this forever. So we knew it was coming, and hopefully everybody's saved some money and they're ready to move into this next economy we're going into, because it's good for us.
What are your thoughts, Joe? What are your thoughts going forward for 23? Where do you see opportunities, and what are your thoughts, kind of on the market? What are you thinking?
I really think that you're going to see some opportunity. There's multifamily is something I'm very bullish on in the right market. But LA is kind of tough. But it's a bit of a battle. But we're looking here. We're looking in Texas. We're looking all around the country. We're looking up north. But multifamily is something we really like. And but again, it's finding the right assets. We've got cash sitting on the other side. We're going to invest in some STNL stuff, probably depending on where the economy goes, but over the next several months. But we're going to buy some more STNL stuff. So we have in Dallas, Texas, we have Chase Banks, Jack in the Box, stuff like that. And so we're going to continue that growth because that's just good, safe. I don't have to management. The most I get is I get a little ping every month. The money's hit the account. Thank you for playing. And where I was doing multifamily investments before, there's a lot of management.
That can be, yeah.
So, and where we're focused on growing our brokerage company, we've really just kind of stepped back from that. And we got very fortunate. We had multifamily properties around Texas, and a guy wanted them, and they weren't on the market, and he came in and paid a price. I mean, our plan was to vacate it, demo it, add about 20 or 30% more units, and then re-tenant it. And the numbers he came in at were just about at that level. So we thought, why should we go through the brain damage? Let's just go ahead and unload it. And but now he's got them back on the market, and he will never get the price that he's. He overpaid a little bit, and we even told him, listen, you're being pretty aggressive on this pricing, and because we didn't really care if we sold it or not. We weren't in the market, but and then he put a bunch more money into it, $1 million or $2 million into it, and he's got them back on, and there's just no way. So, but he was syndicating them, so he's got his investors' money, and he was a contractor. So he's a contractor and the syndicator, so he was double dipping across the board. And so his investors are probably going to be struggling a little bit, but multifamily in the right areas I like. The STNLs I like. Retail, again, if you can get in the right location, you got a good traffic count. You got like everything that you said before.
Right.
Traffic count, walk score is good. Good tenants in the area. We're starting to see that loosen up a little bit as well. So I think there's going to be a lot of opportunities. So save your cash, and and stay patient.
I think honestly, and that's the thing. That's one thing I think a lot of people, I think, and I want to think of one of the third things I said here, and just thinking about it, if you buy whatever you buy, what's your exit strategy?
Yeah,
you know what I mean. And one of the things one of the thing I learned at GE Capital, especially during the financial crisis, we thought we had a pretty diversified book of a lot of things, right? But when you go to some tertiary, secondary markets. You potentially get a good buy, if you will. Yeah. But when things freeze up, or there's just not as many active institutional buyers. So I mean, I'm always super careful about knowing my exit, and especially when you ask about before the syndicated credit stuff, or I keep syndicated credit, but I say the syndicated equity, and things, you and I don't know. I don't know what, I just look at the bunch of stuff we underwrote. We did it a 4 cap, multifamily in Houston. We're assuming it's a 5-year hold, and we're going to exit at 5. Guess what? That deal now would underwrite probably out of 5, and it's probably going to exit at a 7.
Yeah.
So, you look at those economics, and that's a much different economic story and than it was a year ago. So I'm always just super, super careful, kind of knowing your exit and kind of the things that'll come up along the way.
Yeah. That's the thing is being patient to do it. My second one, and for anybody that watches this channel regularly will know that my first investment in multifamily was a home run. I was 28 years old, and I thought I was, I hit the jackpot on the first one. The second one brought me down real quick. A 3-story walk up. Turns out, in a low income community, turns out that community doesn't want to carry the groceries all the way to that top floor without an elevator. So yeah, we ended up getting out of it and making a little bit of money, but not, it wasn't a great investment. So, and that's because I was impatient, and I thought because I hit that home run right off the bat, I really knew what I was doing. And so the third one was a good investment, because that second one,
Yo, how many investments have you made over the years?
oh, you know what? I can't even count. We've syndicated a good number of, probably less than 10 actually, but
Okay.
we've done a good number of them, and we've invested in a good number as well. And so I love investing. We're going to continue it. This STNL thing we just got into a year and a half ago. Because we were always multifamily before, and so I'd like to get back into doing some multifamily, but also continue the path of building a portfolio with our STNLs. And a lot of the reason is I want to create a syndication, which I'm probably going to want to pick your brain about, is how I can do it. I want to make sure that some of our newer agents, I just think that real estate agents should own real estate, or at least be invested in it. And I want to create a vehicle where they can do that along with us, so they can own a piece of real estate, because in a downturn, it's always nice to have those dividends coming in, right? So
That's right. That's
so I
right.
might pick your brain on that at some point. But Jack, this was great. I think maybe we need to do this often. We need to get you back on
I'm
here.
telling you, Joe, it's been fun. Honestly,
Yeah,
I really enjoy,
yeah,
honestly, this has been great. Candle, I've learned, even before we started, I learned a bunch from other, some
yeah,
other things here. So fully enjoyed it, and like I
yeah,
said, I'd love to, break some bread with you at some point here
yeah,
too as well. And I know you mentioned that conference that you just attended. I was a month or
yep,
two ago as well.
yep.
And
Commercial Real Estate Influencer Summit. It's a great opportunity for commercial real estate agents. It's never stop learning, right? We always want to be
100%.
learning, and I've learned more from these conferences. I very specific. ICSC I've gone to a couple times, but that's more about getting business. I tend to lean toward the education side of it, because
Sure.
with this website I do a lot of mentoring, and but you never stop learning in this business, and you won't. And if you're an active investor, you're going to continue. If you're going to go into a new market, the way things change in the cities, I love it.
Joe, I think you're right. I think we talked about that. I think in terms of, and I admire what you're doing with your agents,
Oh, it's
and
fun. Thank
you're
you.
investing in them, we don't, and I think we're both realized too, we all earlier in our careers have home runs, and guess what? We get quickly humbled. We
Yeah,
get humbled along the way. Every day I get humbled, right?
yeah,
It's
yeah.
unrealistic.
It's something. It's you can, it can be hard on your ego, but it's also, you just need to learn from the lesson. But well, Jack, thank you very much. I know that I've kept you a lot longer than I promised to, but your information is so valuable. You might get some comments on this video. People, don't hesitate to ask Jack anything you want to know, and so about real estate, because he's been in the business a long time. Make sure you check out Summer Street Advisors. I'll put a link down to them as well, so you
Right.
can check it out. And Jack, thank you very much.
Joe, you've been really enjoyed it, and looking forward to working with you on some other stuff.
You betcha. And for those
All
of
right.
you watching, make sure you give us a like. And if you haven't done so, make sure you subscribe and check out all of our other videos.